This is Software Engineering Radio, the podcast for professional developers on the web at se-radio.net. SE Radio is brought to you by the IEEE Computer Society and by IEEE Software Magazine. Online at computer.org/software.
Hello all, welcome to Software Engineering Radio. This is your host, Kanchan Shringi. Our guest today is Casey Aylward. Casey is a principal at Costanoa Ventures, an early-stage VC firm. In today's episode, we will explore questions an entrepreneur may have when starting to think about obtaining VC funding and what VC firms look for. Before Costanoa, Casey was a software engineer at Pinterest. Casey is now focused on sourcing, evaluating, and investing in the next generation of enterprise software companies. She has invested in companies like Coiled, Cyril, and Stackhawk. Welcome, Casey. Really looking forward to our conversation today.
Same here. Thanks so much for having me on, Kanchan.
Before we start, I'd like to point listeners to 3 related episodes. The first is 373, Joel Spolsky on startups growth and valuation. Episode 448, which is Matt Abersfeld on starting your own software company. And for the last one, I don't have an episode number yet, but it's Roland Savage on getting acquired. Casey, let's jump into it with a very, very basic question. What is venture capital and what is private equity?
Sure. So venture capital is a form of private equity and a type of financing that investors provide to startup companies and small businesses that are believed to have very high growth potential. So they're similar in that they both want to see the value of the equity that they purchase increase over time. But there are some pretty key differences with the types of companies that they invest in. So I'd say both in terms of the company's life cycle and how fast the business is growing, some pretty key differences with how much capital they put to work, and then also with how much of the company they'd likely own after the transaction. So I'm a venture capitalist. I'm investing in early stage companies. And in some cases, these are pre-product 2-person teams with no revenue. And in some cases, they're a little bit further along. As I mentioned, we hope that these companies are growing pretty quickly, and we'd hope to own about 20% of the companies. So founders would very much be in control of the board and also own a majority of the company's shares. In private equity or PE, the companies are going to be much later staged, potentially not growing super fast or distressed, but they'll definitely have significant revenue. And so a PE firm will come in and buy a controlling stake of the company and usually make pretty big changes to it. So maybe replacing the management team or sort of infamously cutting lots of roles from the company. And by correcting these, quote unquote inefficiencies, they hope that the company will get back on track and growing more quickly.
Okay, so my key takeaway was venture capital, more early stage, private equity is probably at a much later stage. But even with early stage, can you talk about angel investors versus seed investors and VCs? You say you're an early stage VC, but how do you compare to angel and seed investors?
So there are a handful of differences between angels and VCs. I'd say the big ones are where the capital's coming from, when each one might invest in a company's life cycle, probably the check sizes they're writing, and then potentially some of the corporate responsibilities. So angel investors are investing personal capital into companies, whereas a venture capitalist, VC, is investing institutional capital on behalf of their limited partners. So think something like a university endowment, a large pension fund, or high net worth individuals. So to take an example, maybe of a very early stage security company that was just founded, to get the initial product built, the founder might raise a $200K friends and family round. And obviously include, mom and dad, but also some other angel investors as well, who might be senior operators or technical experts in the security space. And the check size is going to vary a lot. It can be anywhere from, single digit thousands up to maybe 100K. So then, the security company with that initial capital begins to grow. They start monetizing, and then they want to go out and raise a $2 million seed round 6 months later. And unless you have very rich friends, you're going to have to go and talk to a venture fund that invests in seed companies. So a VC might offer to invest a good portion of the round, let's say $1.8 million of the $2 million. That remaining $200K of the allocation might go to angels or maybe another smaller fund, but they're going to be a much smaller portion of the round overall. The VC will also probably go and create a board seat with this round of financing. So there will be some governance component that emerges out of the financing.
So angel is personal, VC is institutional with other related structure.
That's right.
You talked about rich friends. What about crowdfunding? There's a lot of emergence of crowdfunding today. Can that take the place of rich friends?
Sadly, we all can't have rich friends. I'd say, crowdfunding is very interesting. Previously, companies were only able to raise capital from accredited investors. So, that's what we're talking about with rich friends, these high earning or wealthy individuals. That all started to change. In 2012, the Jobs Act passed, and this changed something called Title III, which really enabled what we think of as crowdfunding today. And Title III is also referred to as Regulation CF, if you want to go and learn more about it. But essentially what this did was allow early stage companies to raise up to $5 million from any individual. So not just institutions or accredited investors. So at a high level, crowdsourcing is generally good for the industry. It allows people who are not accredited more fair access to private investment opportunities. And as we all know, there are a lot of gains happening in the early stage private markets. So even though it is a risky asset class, the SEC decided to not limit access to it. In my opinion, I'd say crowdfunding isn't right for every type of business. I think it's probably better suited for consumer products, maybe a physical good, where you can spread the word via the crowdfunding campaign and your customers can become your investors, so to speak. Where it's not great is really for enterprise businesses because you have to disclose a ton of information to the public. And so if you're building an enterprise software product and have competitors, that's probably not the most advisable thing.
Okay, so I think that sets the stage, at least for me. I can understand the difference between angel and institutional funding, and a little bit about crowdfunding too. I'd like to focus for the next few minutes, maybe several minutes, thinking through the point of view of someone who is maybe 3 or 4 years out of grad school and has an idea. If I am that person, how do I go about executing my idea? Should I raise money right away? If not, how do I know when the time is right? As someone who may not know much about this, can you give us some advice? Can you give me some advice?
Sure. So raising venture capital isn't right for every business because once you raise outside capital, you have a level of responsibility to produce a return on that money. So you sort of have that extra layer of accountability. And venture businesses, in a lot of ways, are valued off the growth rate of the business. And so if you don't think that what you're building will be a high growth opportunity or that's not achievable, then it's probably not the best option. So there are plenty of things you can do, though, before raising capital. Of course, you should be having lots of conversations with potential customers and folks in the industry, maybe validating some wireframes you built to get early product feedback. And, depending on what your specific skill set is, possibly co-founder dating, if you're looking for someone to really balance out the skills of the founding team. And so I'd say ahead of making that decision of whether or not to raise VC money, it's common for founders to bootstrap with their own money. So to keep bootstrapping, though, you have to have customers paying you pretty quickly to remain a viable business. And that's going to be hard to do if the product is just built and maintained by one person. You'll probably need some capital to go and, hire engineers or maybe someone to service your customers. So one option, and I've seen this done in a handful of companies, but some businesses might start out more in a professional services capacity, solving a very specific problem, and then sort of productize from there. And so that's one way I've seen a handful of successful bootstrapped businesses get off the ground.
So it sounds like it might be a good idea to bootstrap with your own money. When you start wanting to grow, you want to make the team larger, you explore VC funding. So I did that, and I have a choice now. I have a few different investors that I want to approach. What should I look for? What value can a VC bring to the table other than capital?
So when you pick your first early stage investor, it is important to remember that this person could legitimately be on your board for 10 years. So it's definitely an important decision and not something to go and rush into. So I think beyond capital, I'd want to know if I trust the person. Do I respect their opinions? Do I think we're capable of having intellectually honest, maybe even challenging conversations together? And so for founders, I'd really reference the VC, talk to founders that they've worked with where things, went well, but also where things really maybe didn't go well. And I think you can learn a lot from those conversations. Also, as more capital has come into the early stage markets in recent years, it's definitely been forcing VCs to redefine their value to remain competitive in the market. And so early stage partners and firms are becoming more specialized in their investment sector focus areas. 10, 15 years ago, there were plenty of generalist funds and partners. And now we see funds that are highly specialized at the early stages. There's a fund called HeavyBit, for example, which is focused on working exclusively with developer tools companies. And so firms are continuing to build out these sort of value-added portfolio programs to support founders depending on what space they're in. As an example, Costanoa has senior partners in sales, marketing, and talent recruitment, and they do nothing but work full-time with our early-stage enterprise portfolio.
So it sounds like, there is this concept of building trust and long-term, because you are going to be working with the investor for quite some time. And there are firms that are specializing in areas as well. So, I decided who I want to approach. What should I be prepared with? You did hint at some of this in your bootstrapping discussion, but, we know of many companies in the late 90s that got funding based on the idea alone. What would your advice be for the entrepreneur today? How far along does the idea, really should be in the implementation before approaching a VC?
So I'd say every interaction with an investor, whether it's a formal pitch or maybe just a friendly catch-up meeting with someone you know pretty well, it's an opportunity really to test your story. And so while fundraising and investor relations are not the most important part of building a company, it's still an incredibly important piece of it and can definitely give your company a real advantage over its competitors. So more tactically, I think at a very minimum, if you're just starting to think about raising and are having casual conversations with a VC, I really recommend writing a one-pager. This is not something you need to share externally, but it'll just help kind of distill your thinking on how you're defining the problem and the opportunity that you're tackling. You don't really need to have customers or revenue, but you need to have done significant customer discovery. I'd say if you're actively trying to raise capital, it is definitely my strong preference to have a deck and a plan. Even if you don't have a product yet and you haven't hired really anyone else on the team, I do like to see the high level plan that includes, the hiring ramp, product milestones, and sort of the projected customer traction. And to me, the reason I love to see it, even if the company is really early, is it just shows that you're thinking strategically and can kind of tie those basic business pieces and blocks together, which is obviously an important trait in a founder and CEO.
So have a deck and a pager, a deck related to the business plan and a one pager on the idea. You must have seen many of these pitches. What makes a good pitch?
So I'd say all good pitches come with a ton of practice, no matter how experienced the CEO is. There are a few things that founders can do in a pitch that I really like personally. The first thing is proactively addressing the risks in the business instead of sort of hiding them away. For example, if your product or company is very blatantly competing with another large player in the market, but you never bring it up once in hours of conversation, I just don't think that's very realistic. So I like to see those be addressed proactively. The second thing I like to see is having the founder share what kind of key metrics they're tracking internally, whether that's on the product side or on the customer side. I really like the quote, "You make what you measure." And so sharing the handful of top level company goals that you care about gives me a better sense of what's important in the business. The third thing I like to see is sharing learning moments. I really like when founders talk about how they've gotten to where they are today. And of course, no startup journey is linear. So having the humility to share mistakes and more on the experiments you've run paints a more realistic picture of what it would actually be like to work together. And then the last thing is, less about style, but of course, it's always exciting to have a recent burst of momentum. So maybe you've just closed a really large enterprise contract, you've hired a key exec, or you just announced a product feature. But it's kind of nice to see those tangible milestones as well.
Sounds good. So share learning metrics, and of course, a recent success is awesome, which certainly energizes everyone.
SE Radio listeners, we want to hear from you. Please visit se-radio.net/survey to share a little information about your professional interests and listening habits. It takes less than 2 minutes to help us continue to make SE Radio even better. Your responses to the survey are completely confidential. That's se-radio.net/survey. Thanks for your support of the show. We look forward to hearing from you soon.
So, we had a good pitch. We want to work together. Now I understand there are multiple phases of funding. I've heard of A, B, and C rounds. Can you talk about that?
Sure. So each round from seed to C, I'd say, is underwriting a different kind of risk. And each round, as we see companies raise more money at higher valuations, is really to recognize the continued growth and progress from the last round. So most seed investors would say, very basically, that they're betting on the founding team and that the market is a good one to play in. And I generally do agree with that. I'd say seed rounds today it's kind of a wide range, but in between $1 and $5 million, usually falls somewhere in the middle. At Series A, a company will have some revenue. The market right now, as we've sort of alluded to, is valuing companies ahead of traditional benchmarks. But when I think of what a traditional Series A was like, and maybe this was 2-3 years ago, the company would maybe have about $1 million in annual recurring revenue, ideally added in the prior 12 months, and the signs of kind of an early talented team and maybe some initial signals that they're getting ready to build out some scalable processes on the sales and marketing side. And a Series A in this market is a little bit bigger, but it might be between, $8 and $15 million. When you go and raise a Series B, I'd say the bet is really on whether or not the company is ready to scale. So the company will probably have between, $3 and $10 million in annual recurring revenue. And later stage investors will want to put more capital to work. So they might be investing close to $30 million in the round. And then Series C investors come in and they're usually betting on the continued scale and typically proof that the market is big enough for the company to continue to run. So, of course, those rounds are even larger than the Series B and even higher valuations.
So how much money would I need? And, how long can I keep getting funding before my company really needs to be self-sustaining or, I think you talked about Series B was up to 30 million. So how much money, should an entrepreneur typically have to raise?
Right. So we typically recommend that founders raise about 2 years of capital with each round. If you want to raise a little bit more and the terms are good, then it may make sense to raise a little bit more capital and give your company a bit of buffer. I'd say on the specific amount to raise, some products, like an enterprise grade security product, may just take a little bit more time to build because of all the product requirements that it may entail. So, you might see a seed round for that type of product closer to the $5 million amount that I stated earlier, but maybe for a more simple product that you can launch quickly, you might raise, $1 to $2 million.
So 2 years capital with each round. Is there some advice there with related to also how much equity you need to give away? How do you balance, how much money you raise versus how much equity you might have to give away?
So I'd say the average early stage round in aggregate has the founding team taking between 20 and 30% dilution on the financing. If the team is more experienced or maybe you've had some fast traction, you can get closer to that 20% dilution mark. I'd say it's hard to take less dilution than this because most leading funds are going to be ownership centric, and 20% is really seen as that line that most major funds are trying to get across in the early stages.
So then by the time the company has gone public or, has been taken over, how much of that equity is, gone or distributed, I should say, to the early stage employees or to the investors?
So the answer to that depends on how much capital the company has raised privately and also what the terms were on each round. I'll also add too, if you have multiple co-founders, that will have a pretty significant effect on how much you might own as an individual by the time your company goes public. I think it's most common for the founders to own between, 10 and 20% of the company at the time of the IPO. That can be one founder, or it can be a group of 3 or 4 co-founders. But again, this can vary pretty significantly. So I'll give an example. When Snapchat went public, the 2 co-founders, Evan Spiegel and Robert Murphy, owned a combined 37% of the company. On the other end, when Lyft went public, the 2 co-founders jointly owned about 6% of the business together. And it's important to remember too, IPOs are a dilutive financing event. So you are raising money and diluting yourself in that process.
I've heard about safe notes. Are they different from giving up equity?
So safes have become pretty popular in early stage companies. SAFE stands for Simple Agreement for Future Equity. And it's a type of financial instrument that Y Combinator popularized in the early 2010s. As you can tell from the expanded definition, it's an agreement for future equity. So it's actually neither debt nor equity. Safes in today's world, when we talk about them, are typically being referred to as post-money safes, which is actually a little bit different from how they initially started when they first came out. Founders like safes because they don't really have all these governance components that equity rounds have. And so they really keep the legal diligence and the legal fees and all of that to a minimum. And so you can close your round out pretty quickly, sometimes honestly in a matter of days. And with the governance component, as I mentioned, there's not going to be an official board created for the company or anything like that. So all in all, they are a very founder-friendly instrument, and we're in a founder-friendly environment. So we do see a lot of them at the early stages.
A slightly different track now, but continuing on our journey as an entrepreneur, how should I be thinking upon getting all the return on my hard work? Do I really have to wait until the IPO or acquisition, or is there payoff as navigating through all the stages of funding?
So it is pretty challenging to get significant liquidity or payoff before an IPO or a good acquisition. The trade-off, of course, is a smaller near-term salary for the potentially huge value of your equity over time. Before an IPO or acquisition happens, though, there are a handful of ways that some founders can see payoff, but they traditionally come with hitting business milestones or, raising another financing round. So to start with, executive compensation does increase over time, but it's usually tied to company performance and financings. Another thing some founders can do is to sell a small percentage of their holdings, usually at incremental rounds. So investors might allow a founder to sell something like up to 10 or 15% of their shares at the Series B or C. And since it does take a longer time for companies to go public these days, it's close to 10 years, founders may value having some cash today to do something like buy a house or send their kids to college, for example. Investors definitely do prefer that the amount sold to be a little less, since we do want that alignment with the founder, and we do want them invested equity-wise. We do recognize, though, it can be pretty meaningful to founders to take a little bit of capital off the table with success before an IPO or an acquisition, though.
So just summarizing our conversation over the last several minutes, as an entrepreneur, I should be careful about the pitch. I would start with a seed round, and the goal would be typically to make sure I have about 2 years of funding as I move through the B and C rounds. At the IPO stage, or as the company progresses, and when I come to the IPO stage, I would expect that the co-founders typically have up to somewhere between 20 and 30% of the equity in the company, or could be lesser as well. Is that a fair summary?
Yes, I think that's a fair summary.
So that's it. Couple more questions here. What common mistakes would you see a first-time entrepreneur make that would make this journey not as straightforward as we have painted the picture here?
So I have a few that come to mind. The first thing is not picking the right co-founder. So if you have two co-founders, you want to make sure that that atomic team can both sell and build. And I think one without the other is going to put you at a disadvantage. And so you want to make sure you bring on a balanced skill set when you're getting started. There are some exceptions, but I'd say for technical products, I do like to see that balance in the founding team.
Today's sponsor is Spot by NetApp, the cloud automation platform that makes it easy to deliver continuously optimized infrastructure at the lowest possible cost. Get the most out of your cloud investments by automating cloud infrastructure to ensure performance, reduce complexity, and optimize costs. Their machine learning and automation scale to exactly meet application needs using the most efficient mix of instances and pricing models, eliminating the risks of over-provisioning and cloud waste. Leverage Spot with all leading cloud platforms, services, and tools. Check them out at spot.io/SERadio, where you can find more information, request a demo, or even start a free trial.
So the co-founder is important, and then expanding to the team. You mentioned on your website that early stage investing is really, really about the team and the people. What do you mean by that? What else do you look for in the people and the teams?
Yeah, I'd say all of my investments are fundamentally a bet on the founder or co-founders. And I look for a handful of key things. The first one is really the ability to hire and recruit great talent. So this is always surprising to first-time founders, but they probably spend up to 50% of their time recruiting in the first year. So if you're spending that much of your time doing something, hopefully it's, highly leveraged time. The second thing I like to see is really this sense of urgency and sort of an obsession with the product. So again, building a high growth company, it's not for everyone. And you do pretty much have to be a little bit crazy or obsessed to want to do it. So, do you light up with positive customer feedback? Do you show up, a week later after our first meeting with a ton of notes from all your customer interviews or new wireframes? I love to see that passion and, level of excitement and commitment to the problem. And then the third and final thing I'd say is to really have a growth mindset. So as a seed stage company, you can't just say, all right, that's it. I think we, solved the problem here. The product is usually a really narrow slice of functionality. And once you start working with customers, you've started to earn the right to actually hear them give you real feedback. And so it's important to really keep your ear to the ground and listen to what they're saying and then build the right next thing. So hearing not just what you want to hear, but is a really important trait that I look for in early stage leaders.
Thanks for that, Casey. I think that rolls into my next question and next segment, which is about working at a startup. So if I am looking to join an early stage company as an engineer, how do I decide if it's worth it given that so many companies don't actually make it? So some of the insights that you shared about looking at the company from a VC angle may apply here, but somebody that's looking for a job may not have all that kind of information. So what would you advise that somebody that's looking for a job at a early stage company figure it out?
So the truth is, early stage companies aren't for everyone, and that's fine. But I do think that everyone can benefit from trying it once. It's good to know what you want to get out of the experience before joining the company. Do you want to become an engineering manager? Do you want to work in a customer-facing function and get more hands-on experience with customers? There are certain goals that you can set up for yourself so that you come out of the experience having learned something new. The people that I know working at startups typically name, two things that really drew them to the opportunity. The first thing, is the team. And the second thing is usually having an impact. So startups are a really high velocity learning environment. And at a startup, if you need to build something or do something, it won't happen if you don't do it. At a big company, there might be a dozen other people who can do your job. So some people love that level of responsibility, and some people really don't like it. I've also seen startups be a great career accelerator. So especially if the startup is growing quickly and on a good trajectory, and you're at that company early, you really have the trust of the leadership team. And so you can really quickly grow into leadership roles that otherwise might have taken 3 times as long climbing up the corporate ladder, so to speak, at a much more established company. And then the final thing I'll say is if you are potentially interested in starting a company, but don't yet quite feel ready to do that, being in a startup environment is probably the next best thing to prepare you for that. So it's good to test it out and see if you enjoy that sort of environment.
Thanks, Casey. I think a lot of that may have come from your experience at Pinterest as well. Is that right?
Yeah, that's right. I worked at Pinterest, and then I also worked at a seed stage company called URX. That was a YC company back in the day. And I think that working at a startup early in your career is a great move. As an engineer, it can be a really awesome learning experience either way, because you're going to get to build something, usually from scratch. In general, too, I think early stage technical hires tend to be actually a little bit more senior in their career. And so if you're joining a startup as a more junior engineer, you're going to get to work really closely with these senior level ICs. And that doesn't always happen at big companies. At big companies, I'd say there are really standard development processes, and it's rare to actually get to build something from scratch. When you're in a startup, every developer in the early days is a decision maker, and your work really has outsized effects on, how things grow over time. So what languages you pick, the tooling and standards that you set up, all of those are actually really critical decisions. And so again, if you're thinking about working at a startup, definitely go in with an idea of what you want to get out of it. But I think as an engineer, it's great because you'll get to actually build things.
Right. So put on multiple hats and build. So switch gears now and let's talk about the VC firm itself. So you made the transition from a software engineer to VC. So, is working at a VC firm an interesting and attractive career path in itself from what you've seen so far?
It is. I'm obviously biased, but I think it's also one of the only finance jobs where you can probably wear a t-shirt to work. So that's pretty important. I think, in seriousness, there's no other job where you have to be learning constantly this much. And I definitely value that. I think besides maybe starting your own company, this might come in second for just how much constant education you have to be doing. In addition, the exposure you get to really talented founders, executives, and other industry experts is unparalleled. And so that's, a thing that you can get addicted to pretty easily. From a macro perspective, there is definitely more value growing in private companies today. Anecdotally, a lot of investment bankers are trying to move into tech since they see this and the lifestyle is better. So it feels like there is just so much opportunity at the early stages. And as a VC, you're getting to work alongside and are compensated alongside a company's success.
So how was your experience when making the transition? What did you have to learn? What did you have to maybe unlearn? And how did you acquire business acumen?
So I think working at a startup, I actually did get a lot of exposure to some of the business aspects. I had early exposure to our customers, their feedback, what the key metrics were inside of the business. And so I think I learned a lot through osmosis, just being on such a small team. When it came to my role as an investor, you're right, I did have to learn some of those business fundamentals. But I do think, again, they're learnable and something you can pick up on the job. And quite frankly, in early stage investing today, there isn't too much financial data. It happens to be quite theoretical or maybe high level. At Series A, that starts to change. But at the end of the day, you're looking at a financial model and really asking high level questions like, what are the key assumptions or risks here that we're underwriting in the business? I'd also say when you invest in a company and see it grow over the course of a number of years, over many board meetings, over regular meetings with the founders and the key executives, that additional increase in complexity feels really natural. And so again, you get to learn a lot on the job. And because I'm working with, almost up to 10 early stage companies, that means I get to learn things pretty quickly.
So learning on the job is, of course, helpful, but starting at an early stage company was also helpful, it sounds like.
Yes, that's right. I think the empathy that I have for early stage founders as someone who has been inside a very early stage business, that piece of it, I definitely value having, but a lot I've just had to learn on the job.
How is a VC company structured?
It's complex, but a VC firm typically has an operating company that's an LLC or a limited liability company. And this is the company that operates our business, pays the rent and salaries and other expenses. For the capital that we're actually investing into companies, that's coming out of a fund. And each fund is a unique limited partnership. And so the capital for that limited partnership is coming from, what we call LPs or limited partners. And so LPs for us are things like pension funds or university endowments. And I'll note that those LPs do not have investment discretion over the capital. It's actually the general partners of the limited partnership that will make the investment decisions. Every fund is a unique limited partnership. So every fund will have its own unique cohort of investment companies within it. And once a fund is fully deployed and the next fund is raised, the investment team then starts investing out of that next fund, which will have its own separate cohort of companies.
So my summary for that would be that, as you had mentioned very early on, the venture capital firm is an institutional investor. So within the venture capital firm, there are multiple funds that raise money. And as each of them mature, then they're used to then further invest in early stage software companies.
Yep, that's right.
So you've been at Costanoa now for several years. So I'd like to ask you a little bit more questions on how you are measured. So as an investor, how are you measured and what do you plan for? As you know, a certain number of investments would be a hit. So how do you measure that probability and how do you make sure that you're successful?
So, of course, when we invest in a company, we want to believe that it has a major, major outcome at the end of it. I'd say, though, in early stage venture, looking at it from the fund level, realistically, what ends up happening is, unfortunately, more than half of your companies are going to fail or not reach an outcome. And this is, of course, an early stage venture. I'm not talking about much later stage companies here. So I think it's fair to say, and this is a little bit of anecdata, but I'd say less than 10% of the companies in a portfolio are going to go and produce the vast majority of returns. So maybe 10% is producing 90+% of the returns of the fund. On a more formal basis, there are a couple of metrics that we use in the industry to measure performance. The most important one is called DPI, and that stands for distribution to paid in. And basically it measures what you have distributed back in capital to your LPs. So if you have a $100 million fund, you want to return, let's say, $400 million or more in capital back to your investors.
SE Radio listeners, we want to hear from you. Please visit se-radio.net/survey to share a little information about your professional interests and listening habits. It takes less than 2 minutes to help us continue to make SE Radio even better. Your responses to the survey are completely confidential. That's se-radio.net/survey. Thanks for your support of the show. We look forward to hearing from you soon.
Okay. Your process really is ensuring that you are investing such that you have a certain percentage of return for the folks that are actually investing in the funds for the VC itself.
Yeah, that's right.
What does a successful exit look like for an early stage investor in a company?
So a successful exit for an early stage investor will depend a good amount on the size of the fund. And so, it's not just about getting a company to IPO or a high-priced acquisition. What also really matters is how much ownership the venture fund actually has in that company. So typically you want material ownership, I'd say between 10 and 20% of the business, the more the better. To return a fund that is maybe $100 million, you're going to need at least $1 billion or a multi-billion-dollar outcome to return that fund where you own a material percentage of the company. But if you're a $400 to $500 million early stage fund, you're definitely going to need to have a couple of multi-billion-dollar outcomes to produce good returns for your investors.
Okay, so let's talk about your investment philosophy when it comes to selecting ideas. What is it about the idea or technology that you look for?
So I'd say, team and founder market fit really do determine the bulk of why I would invest in an early stage company. Good ideas, people see them, they end up getting copied, and you might have a head start of a year or something like that. But ultimately, it's just going to really depend on your ability to build and execute quickly. That being said, there are definitely a handful of things that I look for with an idea or a certain piece of technology. And those probably fall into 3 categories. The first thing is I'm looking for a scoped and defined end user value. I'd say especially with technical products, you can't go in and say, you're going to have this problem in the future as an organization. You really have to solve an individual's problem today. So that's a big one, especially in technical products for me. The second one is the adoption paradigm and how much time it takes for an end user to see value. So the way I ask about this typically is I'll ask, what does your onboarding flow look like? And so I'm trying to get a sense if the product is complex or simple, what it looks like when you deploy it. And this very basically tells me a couple of things about what the go-to-market motion might look like for the business in the early days. And then I'd say the last thing I look at and care about, especially again with technical products, is the ecosystem of tools and the developer community around it. Of course, as we know, developers have things they fall in love with and want to use. And usually, that toolkit that they're using, all those tools are compatible with each other. So you can't come in and reinvent the wheel and have them relearn everything. So I'd say typically the ecosystems around these tools, especially if they're open source or maybe language specific, aligning with those communities early on is a pretty powerful thing. So I definitely look for that in early technical products that I'm backing.
Okay, so fit within the ecosystem, solve a real immediate problem, and have, simpler onboarding. Those are the 3 takeaways I got.
That's right. I think developers can be lazy sometimes. And if you can't show a developer something that excites them within 15 minutes to an hour, it's going to be pretty challenging to get them to come back later and try the product.
What key trends are you bullish on? Maybe right now.
So there are a couple of key trends going on in cloud data infrastructure that I'm excited about. As we know, there's a ton of activity in the open source ecosystem, and I'm seeing a lot of compatible tools emerging at every part of the data stack. And what's great here is that you can really pick the best in class tool for your specific use case and sort of stack them all up together. So one area that's exciting, at least I think is exciting, is around projects that are helping to bring data lakes up to par with some of the benefits that something like a cloud data warehouse might provide. So at the data management level, I think there are a handful of emerging projects that are helping give data lakes some of the core data management features like change capture, data encryption, and caching and ingestion. A lot of these are solved in a cloud data warehouse like a Snowflake or a BigQuery, but haven't really been solved for data lakes yet. So I think there's going to be some big developments in that area in the next few years. The second trend is around developer authorization. I'd say with the recent massive acquisition of Auth0 by Okta for $6.5 billion, which was announced, I think, in March of this year, it's clear that developer authentication is a solved problem. I'd say that authorization, though, which is, the act of specifying access rights and privileges to resources, it's still in the very early days, especially for application developers. We're seeing a lot of pain points around this specific problem, and I think there's potential for a pretty big company to be built here.
We'll put some links around what you mentioned, especially Okta. I think that is relevant to our discussion today. Thank you for that. As we start to wind down, I'd like to ask you on a lighter note, if you've seen this one, does the series Silicon Valley represent a realistic experience of a startup? Have you seen it?
So of course I've seen it. The show, in my opinion, is way too real. What I do think it does a good job of is showing that sort of roller coaster that happens in early stage startups. Richard, it feels like, is always battling with someone, whether it's his investors or the CEO of Hooli. And usually, those relationships are not as antagonistic or antagonistic at all. But I think the show does a good job of showing that the startup journey is definitely not, just a linear path. I do think the personas are obviously pretty exaggerated, but in some cases they can be pretty spot on.
And they probably do illustrate your advice on having a good co-founder and a good initial team.
That's right.
Is there anything that we missed today that you would like to cover?
Well, I really enjoyed our conversation. Thank you so much for having me on this, Kanchan. And, if anyone in your audience is thinking about starting a company or wants to work with one, I'd love to meet them. And if you're interested in that, please do feel free to reach out to me directly. The other thing I'll say is that it is a great time to start a company right now. It's a very founder-friendly environment. and there's just a ton of activity. And so, if you're waiting for that sign, I'll say this is your sign.
Especially if you have a solution for authorization.
Exactly.
So how can people contact you if they want to?
So I'm pretty accessible. The best way to get in touch is via email. I'm just Casey@CostanoaVC.com. I'm also active on Twitter. And so if you want to shoot me a DM on Twitter, that's another good way to get in touch.
We'll put your Twitter handle in the show notes.
Great. Thank you.
Thanks so much, Casey. This was awesome. I learned a lot. I hope our listeners did too. This is Kanchan Shringi for Software Engineering Radio. Thanks for listening.
Thanks for listening to SE Radio, an educational program brought to you by IEEE Software Magazine. For more about the podcast, including other episodes, visit our website at se-radio.net. To provide feedback, you can comment on each episode on the website or reach us on LinkedIn, Facebook, Twitter, or through our Slack channel at seradio.slack.com. You can also email us at team@se-radio.net. This and all other episodes of SE Radio is licensed under Creative Commons License 2.5. Thanks for listening.